Hi, I'm Scott Johnson from WholeVSTerm Life Insurance. Welcome to our video. Today we're going to talk about some of the outrageous claims made about whole life insurance. And those top 5 claims include: whole life insurance is a great investment. Whole life is an asset-protected method of savings. If you don't buy whole life insurance, you won't be able to have life insurance forever. Whole life insurance is a great way to save for college, and my personal favorite, whole life insurance is a great way to save for retirement. We'll investigate those together today. Now, one of the first claims that you're apt to hear is for insurance agents to tell you that whole life insurance is a great investment. Well, let's look at the numbers. According to the Wall Street Journal in 2008, the average dividend paid on a whole life insurance policy ranged from between 4 and 6%. Well, bond rates have gone down, so that's unlikely to be the case anymore. It also stipulated that the minimums were typically 2 to 4%. Now, those are paid out on money that is held in the cash account, less any money that you may have taken out in a loan from the life insurance policy, typically. Now, that's not the same as the amount of money that you've paid into the whole life insurance policy. So let's look at some numbers, at least for a 3-year period. On a 35-year-old male in his cash account who's paying $9,485. If he pays that every year for 3 years, he will have put in $28,455, my friends. The cash accumulation in a typical whole life insurance policy would only be $7,060 after those first 3 years. A bank account, including no interest, would have had $28,455. Now, the other thing you need to keep in mind is that dividend rate of between 4 and 6% only pays out on the money in the cash account. So that $7,000 in the cash account are the only monies eligible to get that 4 to 6% rate, not the entire amount that you have put in. Now, some people will say, but Scott, 3 years, seriously? That's not a very long time to assess a whole life insurance policy. Well, you may be right, but the first 3 years really set the standard for how the thing is going to perform later on. It is true that whole life insurance can start making significant gains, but not for decades. So, in general, is whole life insurance considered a great investment? I don't think so. In comparison to mutual funds, 401ks, Roth IRAs, and many of the other financial instruments that you have available to you, whole life insurance is generally not a good investment due to its complex structure, its fees, and its low rate of returns. Now, a second claim you're going to hear is about how the money saved in a whole life insurance account is an asset-protected model of savings. In other words, it's some sort of creditor-protected model of savings. So, this statement has and contains a kernel of truth to it. It should be qualified with it may be a creditor protected. The thing is much of this depends on bankruptcy law, which is a very confusing set of federal and state guidelines. So any insurance agent that's going to tell you this better get their act together and understand what they mean when they're telling you this, because this can mean many different things to people. I wouldn't tell people this because I think that it's so state dependent, and unless an insurance agent is an attorney, it just seems like a story that they're telling you that may or may not be true. But one important note here before we move on to the next point is that state bankruptcy rules are different in every state. For example, we list 3 in our article here about Alabama, Alaska, and Arkansas, and how they all have different definitions of what part of the whole life insurance value is protected in bankruptcy court. And each state has their own rules and regulations about this. So if you meet an insurance agent that brings this up to you, you should ask them the specific rules to your given state. So, is whole life insurance a form of creditor protected savings? Well, it's dependent on the state in which you live in, and I would ask an attorney. The third story you may hear is people that tell you that if you don't buy whole life insurance, you won't be able to have life insurance forever. Now, this is potentially my favorite claim. First off, it's not actually the only way to buy life insurance forever. That is patently false. You could have life insurance in a series of term policies for the rest of your life. You could have life insurance through a group life policy through work. Some of those sometimes can be extended after you retire. You could have life insurance from some sort of nonprofit that you are a part of, a group. There's a different type of group term life insurance policy. But you could also buy something called a lifetime term policy, which is basically a type of universal life. And that's not whole life insurance. So it's absolutely not true that you have to have whole life insurance to have life insurance forever. So as much as I enjoy debunking the myth that whole life insurance is the only way that you can buy life insurance forever, the next part B of buying whole life insurance is the only way of getting life insurance forever, is just the assumption that you even need life insurance forever. It's kind of like asking somebody, well, if you don't buy a ham sandwich now, you won't be able to have a ham sandwich today. It's making the assumption that you want or need a ham sandwich. Personally, I don't like ham. I'd rather not eat ham sandwiches. But the way that some of these insurance agents phrase this question is misleading because it leads people to believe, boy, you know, I plan on having homeowners insurance for the rest of my life. Maybe I need to have life insurance forever. This isn't to say that some people do not benefit from having whole life insurance forever, but certainly it's not the best financial plan of action. The best financial plan is to really have insurance when you need it, when you have dependents or when you have debts that you want to pay off. And for somebody that's in retirement, I just don't think as a general rule they should be paying for life insurance unless they're in one of these kind of special categories. And there are some people, if they have a special needs child or something, where you could make the case that you might want to have life insurance for your entire life. Or if you own some sort of special family property, say a farm, maybe. But even those cases and those claims, the insurance agents are making the statement that basically that you should have life insurance forever, when indeed most people probably shouldn't. So is whole life insurance the only way for somebody to procure life insurance for their entire life? No, it is certainly not. Now, whole life insurance just might be a good way to save for college if you already have a whole life insurance policy and it's fully funded. That's the caveat I would start off with here. But as a general rule, if you're talking about somebody that has a child, 2 children, let's say they're 2 and 4, whole life insurance is not a very good way for them to save for college. And let's run through some of the more popular options available. Okay, we've listed 3 popular college savings options on here. The one that I've left off is the so-called UTMA accounts, which aren't really college specific, so we've left them off. Technically, neither is whole life insurance specific to college. But the 2 that whole life really has to compete with are ESAs and 529s. ESAs stand for Education Savings Account. There's some other names that it goes by. But there's income limitations. So if you make too much money, you can't qualify. They have income limits of how much money you can put in them per year, $2,000. They grow tax-free. 529s don't have the income limits, and there's limits to how much you can put in, but they're much higher. You can put tens of thousands of dollars in certain cases. But the money, as long as it's used for qualified education expenses, can be used tax-free. So the money grows, no taxes. Now, we've talked about the high fees associated with whole life insurance policies. And that's one of the main restrictions that prevent these things from competing with 529s. 529 nowadays you can set up for just very small fees per year. With a whole life insurance plan, not only are the fees high, but the returns, we talked about the 4 to 6% returns on the cash value, are not very high compared to the open market. The last problem you're going to have with whole life insurance is when your kids go to college and when you want the money, how do you get the money? It's not as simple as withdrawing it like a 529. You may have to take a loan out to get access to your own money, and you will have to pay yearly fees to do something like that. So in general, a whole life insurance policy is not a good way to save for college, partially because there's just not enough time in a given 15-year period for the whole life policy to earn enough income to pay for a college education in comparison to a 529. So the last point, I've said this is my favorite, is the statement that whole life insurance is a great way to save for retirement. Now, folks, you've heard about 401ks, you've heard of Roth IRAs, you've heard of backdoor Roth IRAs. Do you really think that whole life insurance is better than the qualified plans offered that are ruled and regulated by the federal government? I don't think so. I've run the numbers. I've looked at the way the accounts are set up. I'm not a financial planner, but I can tell you that whole life insurance is driven with high fees, low rates of return, and it's very difficult to access your money. So let's get into it. Now, retirement accounts. The gold standard of retirement accounts is the Roth IRA. It allows you to put a limited amount of income in each year, and it grows tax-free until retirement, in which case you can choose to take the money out tax-free as long as it's used after you retire. Now, how does a whole life insurance policy work in comparison? You put the money in, it comes time for retirement, how do you get it out? Well, my friends, you need to take a loan out, or you need to take out some of your policy cash value. There are fees and loan costs to do stuff like that. It's not free. You can't just remove it tax-free. There may be tax implications. Another great retirement option is the 401k, which allows you to put money in tax-deferred while you're working and take it out when you retire. Now, you need to pay income tax on it when you take the money out when you retire. But how does that compare to a whole life insurance policy? Well, the same thing. You've got to take a loan out against your policy value or remove the money from the cash value portion of your whole life policy. There's fees and loan costs concerning this. Another consideration with a 401k is that many companies will match a portion of your contributions. Do whole life insurance companies match your contributions? Whole life insurance really is not a suitable replacement, and I commend those insurance agents for speaking what I consider to be the truth. But if you simply run the numbers on a dual working family that both have access to 401ks and to Roth IRAs, then even those insurance agents would have to admit that a family would have to be saving in excess of $30,000, $40,000, maybe even $50,000 per year when you take in potential employer contributions to 401k, potentially $50,000 before it could potentially make any sense to try to save any money in a whole life insurance plan for retirement. But even if you are able to save over $40,000 or $50,000 in all of the retirement accounts that are available to you, and I have not listed all of the options, but those are the 2 or 3 most popular ones, then the question turns around and becomes, then where is the best place to start saving your money? Do I think whole life insurance is the 3rd or 4th best option? No, I don't. There's lots of other places to save your money that are tax deferred, tax free. The first place is paying down your home. Your home carries a mortgage rate, and that mortgage rate effectively is a guaranteed rate of return if you pay it down sooner. Other places are things like HSAs, which stands for Healthcare Savings Accounts, which may be issued through your employer. Low-cost ETFs can be a tax-deferred method of saving. Municipal bonds and municipal bond funds oftentimes can be tax-free. Rental properties, sometimes they can be a better deal. And sometimes even just a simple bank account to build up a 6 or 12-month short-term savings account. So do I think that whole life insurance is a great place to save money for retirement? I don't. I don't think it's suitable for retirement money whatsoever. The thing that most insurance agents won't really explain to you is that when you buy a whole life insurance plan, that means that you seemingly obviously have to pay those life insurance premiums for your whole life. But your whole life includes your retirement years. Why do you want to be paying for life insurance, quote unquote saving for life insurance, when you're going to need the money during retirement? How do you go about protecting yourself against these outrageous life insurance claims? Well, there's a couple of steps that I'd suggest. The first thing is educate yourself. Read online, talk to people, listen to podcasts, learn about all the various forms of life insurance to make your own decision. The second suggestion I have is to ask the insurance agent how they are compensated. Most of them are compensated by a commission. So the more that you pay, the more that they make. Myself included, I am a compensated life insurance agent. The third thing is ask lots of questions. Don't let people tell you it's just a small detail, it doesn't matter. It does matter. You're buying a contract, you need to read the contract. The fourth suggestion is, sounds obvious, but you'd be surprised how few people do it. Run all the numbers yourself. The fifth thing is, when you provide illustrations and numbers, ask to see the guaranteed charts. Many of the charts they will show you are assumed charts. They are based on past dividends. You also need to compare them to the guarantees. The next suggestion seems obvious, but not everybody does it. Compare lots of quotes from different agents, different agencies, and from different insurance companies. And then the last thing is really beware of anybody peddling life insurance to you for any reason other than pure life insurance. And that brings me to my next point, which is a question that people are going to ask. What kind of life insurance do you suggest that most people get? Well, in a generic case, not knowing anything else, I would suggest that most people consider a level term life insurance policy. Questions? Please, let me know. Please read our entire article at WholeVSTermLifeInsurance.com/outrageous-claims. If you enjoyed this long-form video, please like us, share us, or comment. Thanks for watching.